Hello, I'm Andy Hill, and thank you for viewing today's financial market commentary on the recent Federal Reserve meeting and the market reaction to potential policy changes that were communicated by Chairman Bernanke at the press conference at the conclusion of their two-day meeting yesterday. First, the Federal Reserve's assessment of our overall economy was rather good. With economic activity expanding at a moderate pace, labor markets have improved. However, unemployment still remains at an elevated level, inflation running below expectations, and many of the risks that we were so concerned with last fall have diminished to some extent. Keep in mind the Federal Reserve has two key tools at their disposal. First, they control short-term interest rates, which are currently targeting roughly 0 to a quarter of 1% by monitoring the Fed funds rate. Second, the more innovative and new tool has been bond purchases in the Treasury and mortgage-backed securities market at a tune of roughly $85 billion of purchases a month. This has been targeted towards reducing interest rates to stimulate the economy. However, they did indicate that there is the potential, assuming the economy continues to expand and meet their expectations for improvement, that they begin to reduce bond purchases. With this term that the financial media has coined, tapering, was discussed and led to uncertainty in the financial markets. They also did mention that any potential changes in targeting interest rates are still a long way off. Well, how did things turn out in the financial markets over the last 2 days? Well, since the press conference approximately 2:30 yesterday afternoon, once the word got out about the potential reduction of quantitative easing, the reaction has been rather negative. The 10-year bond has sold off, which means that the yields actually have increased from 2.1 to approximately 2.4%. The S&P has dropped by about 4%. Gold has dropped by 5%, while the US dollar has increased by a little less than 2%. Keep in mind our strategy to year to date so far has been to underweight bonds while keeping our maturities short in anticipation of what is actually occurring today with interest rates increasing. We also have been overweighted in equities, which have experienced a very good year to this point, and we've been maintaining a higher than normal cash balance in anticipation of opportunities which now appear to be occurring. In light of the Federal Reserve policy changes to reduce long-term bond purchases, we're biased towards possibly increasing our bond holdings from currently being underweighted to maybe something more of a neutral weighting towards our clients' individual targeted allocation. And we have been over-allocated to equities year to date so far, but we're bringing that under consideration. We'll take a look at the charts in a second to see which way the trends are going to go next. Commodities, which have had no exposure to so far this year, are starting to look a little bit interesting after the significant sell-off in the gold market and other interesting commodities. Briefly, we want to take a quick look at the yield on the 10-year Treasury bond dating back to 2010. Keep in mind the yield of the 10-year Treasury bond is over here on this column, and this should be read as all it indicates 14. That's really 1.4%, where yields bottomed out last year when we were dealing with the European credit crisis and other issues that made investors quite nervous. Recently, the yield on the 10-year Treasury has increased from 1.6 to 2.4% approximately over the last 2 months. The 2.4 level is particularly interesting, as we've been at this level several times before. So I'm wondering as to whether we'll continue to trend higher or whether investors come in and start to purchase the bond at about a 2.4% yield which is considered a tax-free and safe investment as you can get. Moving on to the equity market, a quick look at the S&P 500 over a shorter term time period dating back to last October. We've seen a nice rally breaking through the key 600 level and hitting an all-time high about 2 months ago at 1687. We've been trading above 1600 for some period of time until this afternoon when we pierced that level, which led to a lot of selling. Often investors have key levels in mind such as 1600, and once an indice goes beneath that level, they quite often sell, and I think that's what it was experienced today. However, we're closely watching how long does it take for the S&P 500 to rise above 1600, and if that doesn't occur quickly, we may be more inclined to reduce our equity exposure, as it may be the beginning of a longer drawn out trend to lower levels, which we would want to not have full exposure to the equity market. Keep in mind though, equities do have a way of turning quickly, so we'll keep that in mind. Just to highlight things, the Federal Reserve, despite the market reaction, had an optimistic undertone to the economic outlook. They did do a good job of articulating the potential changes to interest rate policy, and the impact of those policy changes has led to potential opportunities in the bond market while we're watching what's happening in stocks and have an eye towards the commodities that may actually begin to look somewhat appealing. Thank you for tuning in, and I'm Andy Hill.